Welcome back to Money Pop. Warren Buffett is currently sitting on $400 billion worth of cash. Over the last 3 years, he has actively been selling most of his stocks, almost as if he is preparing for a massive stock market crash. Over the last year alone, the S&P 500 has grown by about 27%. If he had invested that money, he could have made hundreds of billions of dollars. But instead, he chose to sit on a mountain of cash while quietly trimming his portfolio. Warren Buffett is widely considered the most successful investor of all time. So why is he stepping back while everyone else is piling in? Why is he staying away from the market when the stock market is growing faster than ever? Is there something Warren Buffett knows that the rest of us do not? Warren Buffett has always kept a large cash pile, but since 2023, he literally doubled it to $334 billion. Since then, he has only kept accumulating more. Right now, he is holding nearly $400 billion in cash. You can understand why he was not aggressively selling back in 2022, because the entire market crashed during that period. But since 2023, there has been a wave of artificial intelligence hype. Every single company is slapping the letters AI at the end of their name, because that is how you attract billions of dollars in investment. Artificial intelligence companies have been signing multi-trillion-dollar deals. Nvidia became the world's largest artificial intelligence company of all time. So while most investors have been actively buying, Warren Buffett has been doing the opposite. He spent most of 2023 selling his Apple shares, even though Apple has been one of the greatest companies in the world. Investing hundreds of billions of dollars is never easy because there is enormous risk paired with enormous reward. Risk basically means the chances of you actually making that money, and reward is how much you stand to gain. An investment can promise huge returns, but what happens if you lose it all? When you are investing a few $1,000s, or even a few $100,000, that is one thing, but when you're deploying hundreds of billions, you have to think twice about every move. In 2022, when the Federal Reserve hiked interest rates from 0% to as high as 5.5% by 2023, the choice for Buffett became obvious. He could simply park all that money into short-term treasuries and collect billions of dollars from the United States government. Loaning your money to the United States government is essentially a risk-free investment. So Warren Buffett earned $52 billion from those holdings, a total return of about 15 to 17%. At first glance, that looks like a fortune for a no-risk play. But if he had instead invested that money into the S&P 500, which has grown by about 80% since 2023, he could have made hundreds of billions. His $400 billion might have turned into $700 billion or more. He would have pocketed $300 billion instead of $52 billion. At the time, though, it was not clear whether the market would continue rising. No one knew if artificial intelligence would actually be profitable. Yes, ChatGPT was already going viral, but it was not making much money to begin with. And Warren Buffett does not personally claim to understand artificial intelligence. If he did, Berkshire Hathaway's valuation today would probably be $2 trillion or more. Individual companies like Google have grown substantially. If you look at their valuation since 2022, it has climbed by about 300%. $400 billion invested in Google during that period could have turned into at least $1.2 trillion. So here's the real question. Why is Warren Buffett still not investing now that it is clear artificial intelligence is real and is driving earnings? Is the market simply overvalued? If you look at Apple's earnings over the last few years, they have not actually grown that much. Back in 2023, earnings were around $390 billion. Today, they are around $410 billion. Microsoft's earnings climbed from about $200 billion in 2023 to nearly $300 billion today, or $281 billion to be more precise. Google's earnings have grown from $300 billion to $400 billion. As long as corporate earnings keep rising, the stock market should rise as well. Because any company is essentially a money printing machine. The more money it makes, the higher its valuation should be. So if earnings are rising every single year, valuations should follow, and Buffett's caution would seem misplaced. But there is one big problem. Most of these earnings are being driven by debt. Total credit card debt since 2020 has increased from $800 billion to about $1.2 trillion. Yes, people are spending money. They are buying new iPhones, new MacBooks, and pouring more money than ever into chatbots. But here is the catch. Most of that money is borrowed. When people borrow heavily to spend, there is a limit. Eventually, they cannot borrow as much as they used to. When you max out your credit card, your bank stops giving you credit. And when that happens, spending slows down fast. It is not just credit card debt either. Student loans rose sharply up until 2022, reaching $1.6 trillion. Since then, they have stabilized because people cannot keep borrowing endlessly. United States auto loans tell the same story. Up until 2022, people borrowed heavily to buy cars. Now, they are not borrowing as much. It is not because people no longer want loans. It is because banks have limits. You can borrow for a house, for a credit card, for student debt, but eventually you hit a ceiling. When you can no longer borrow, you can no longer spend. And when earnings slow, what happens to valuations? Right now, investors are overpaying for stocks in the hope that earnings will keep climbing forever. According to Warren Buffett, investing in this environment has turned into gambling. He recently gave an interview saying the stock market has become a giant gambling machine. In the past, the average price to earnings ratio was around 25. Investors were ready to pay $25 for every dollar of earnings, which made sense because tech companies tend to grow faster than traditional businesses. You are overpaying today in hopes of bigger profits tomorrow. But now the average price to earnings ratio for tech companies is around 40. Investors are paying $40 for every dollar of earnings. That is what is scaring Buffett. If investors have already priced in all future growth, why bother buying these stocks at all? Another major signal is the Buffett indicator. It compares the total size of the stock market to the total size of the gross domestic product. The market value should roughly match the gross domestic product. If it is lower, the market is undervalued. If it is higher, the market is most likely overvalued. Right now, that ratio sits at around 231%. In other words, the stock market is insanely overvalued. In fact, it has been overvalued since 2012 because the last time this indicator was lower than the gross domestic product was back in 2008 when the entire global economy collapsed. Since then, that number has been climbing relentlessly. In 2023, when it became absurdly stretched, Warren Buffett began massively selling. By his own main indicator, there is no reason to invest right now. There are still great opportunities in the market, and small investors can absolutely make money. But when you're deploying $400 billion, it is not easy. Your actions move the market itself. Finding a worthy investment at that scale is far harder than for someone investing a few thousand or a few million. Since 2020, the United States government has been running a huge deficit, borrowing roughly $2 trillion every single year. Buffett knows this is not sustainable. There are two ways the government can fix it. The first is raising taxes. Whoever becomes the next president will likely have to raise taxes. Higher taxes lower corporate earnings, and lower earnings push valuations down. The second option is devaluing the dollar. That is what is happening now. The government keeps printing and borrowing until the real value of the dollar shrinks enough to close the deficit on paper. The more dollars flood the economy, the more wages rise on paper, even if they cannot buy more. The government then collects more taxes, shrinking the deficit. But devaluing the dollar means higher inflation, and higher inflation forces the Federal Reserve to keep interest rates elevated. High rates make future cash flow less valuable, which means tech companies look less profitable on paper. Valuations must adjust, and the market eventually has to correct. It does not mean the crash happens